James, do you accept Professor Haugen's theories, and if so, how far do you feel such quant techniques are permeating the portfolio management world in the external managers which you study for your clients?
I think the concept of minimum variance is well established and is indeed accommodated by many of the leading quantitative houses today. I think also that there is a far more blurred line between what we describe as quantitative and more qualitative decision taking. And I think I would argue from first principles with evidence that most qualitative managers also accommodate these quantitative principles and recognise the value of minimum variance in portfolio construction and instrument selection.
So you've in the past favoured certain groups such as Goldman Sachs Asset Management, which have used the quant methodology in equity investment. Are these types of funds preferable for the core of a private or institutional portfolio rather than the exchange traded funds which have been expanding their base of late?
Well, if we return to the challenge of what we are investing in, an exchange traded fund is simply a means of providing exposure to a set of securities, and exchange traded funds in principle can be wrappers for active funds as well as passive funds, and there can be funds that have ETF wrappers that are managed on quantitative grounds. And I think that there is an issue for those who select managers as opposed to select securities in understanding how managers take decisions. And I think that what draws me to managers with quantitative styles is the absolute clarity and transparency as to how decisions get taken, portfolios constructed and risk constrained. And I absolutely accept that there can be judgmental and qualitative managers who say, trust me, I'm brilliant. But if I cannot understand the theory and the practical steps taken in portfolio construction, I cannot be comfortable that the results will be repeatable in the future in a pattern that is consistent with the requirements that I may have.
The challenge for me is, what we saw through 2008, 2009 was effectively a breakdown in historical risk measures being a good indicator of future risk. So the if you like, the low risk portfolio of June 2008 didn't turn out to be the low risk portfolio of September 2008. The historical covariance matrix wasn't a good indicator of how stocks were going to behave, and that's part of the reason that quant returns were so bad or some quant model returns were so bad in August, September, October, November 2008 was not just that the markets were abnormal, but effectively they were taking more relative risk, more absolute risk than they actually thought they were.
Yeah.
So we need to be a little bit careful that there is this dependence on historical data, which has shown to have a problem in crises.
It's a very interesting question, because if you said to a judgmental manager, how does he get comfortable about an individual security or the role of that security in a portfolio? He or she will almost always resort to some form of data to prove or support the argument.
Yeah.
And therefore, they necessarily are employing some form of quantitative process in supporting a judgmental decision. And I would share your view that in abnormal market conditions, there is a herding or clustering risk, which we certainly saw across the banking world, not just in portfolio construction, and that if managers make the same decisions at the same time, quite naturally, this leads to an accentuation of market risks and extreme behaviours.
Yeah. I'll go slightly further than that and say it wasn't just 2008. I think something was going on throughout the last decade, where we found that the risk-return features of most asset classes were becoming unpredictable. The time period over which risk premium was going to be materializing was unpredictable as well. And something was really happening. And I think fund managers have become far more pragmatic now. The ones that I work with are far more pragmatic than they've ever been. To start with, I don't think many of them ever bought into this efficient market hypothesis, despite the fact that regime was there. And I think they started doing in the 1990s what professional economists had done in the 1980s, which was that we were brought up on the tradition of rational expectations hypothesis. This was 1970s. I was working in the UK Treasury, and we were almost forced to model the entire Treasury model on this rational expectations hypothesis, because we were told by IMF that we're now in a completely different economic paradigm. I was modeling inflation, I was modeling unemployment, and however hard I tried, whichever sophisticated methods we use. We had 3 Nobel Prize economists helping us as well. In those days, we really couldn't find any evidence for what those guys from Chicago were saying. And that sort of thing has percolated down in the 1990s and the last decade amongst fund managers as well. So they're far more pragmatic now. They use the quant screens as a first stage rocket or as a second stage rocket. You know, it takes them up to here, but it doesn't take them that far. You know, they apply far more economic reasoning now, a priori reasoning than ever was the case. And even those 100% quant guys, you know, say the likes of BGI 5 years ago, you know, they jettisoned that paradigm a long time ago. And they basically use an unusual degree of judgment now in what they do compared to what was the case before or what the model was telling them. So I think the world has really sort of moved on quite significantly in that respect, probably very much in the direction that you're talking about, where you look at the stocks, you know, look at them on their own merits, you know, rather than simply sort of saying, you know, that there is a body of theory which really supports that I should be doing this. I think that really has gone. We've really moved on. The key question in my mind is that, you know, so if I was an investor, say if I was an institutional investor and I've got money to give to James, you know, I want to know what is it that he's actually going to do. And in that respect, this new study from the Norwegian government pension plan is very instructive indeed. And, you know, there's some very practical ideas there. But basically, in a nutshell, what it really amounts to is that if you're going to be an active manager, and you should be, because that's what we want you to do, because we've got a big deficit, and the only way we're going to plug the deficit is by really having decent returns. What we want to know is how are you going to do it, and where are you going to bring that special insights which is going to generate alpha? Because, again, in that Norwegian study, it was possible to find alpha or to generate alpha by just, you know, modeling some factors into the active manager's model, and you didn't really need to use much skills. Where is that special insight is going to come from, and what are fund managers doing to generate those insights? To me, that is the most fundamental question. I think this whole theoretical approach that we've had in the past, it was very useful. It helped to discredit many things. And if efficient market hypothesis was valid, we wouldn't have had 5%, more than 5% change in S&P. It would only happen once every 350 years. We've had about 48 changes in the last 100 years. So that's enough to say that that hypothesis doesn't work. We know that.
In your original remarks, you talked about the tortoise or turtle beating the hare in the long term, and I was going to ask you a bit about the time frame for that. We're now talking about the very short market time frames, and perhaps it's related to the fact that the market has a sense that it has been following momentum in a way that has no underlying basis, and the reaction therefore is one of panic when it's realized that there isn't substance beneath the underlying demand. As with any herd of wildebeest, you get a point where suddenly they realize they've just been heading in the wrong direction too far. The extreme recent example of that perhaps was the dot-com crisis, where everyone knew that it was ridiculous that people were buying on revenues only. So there's something about the market, as has been coming out in this discussion, having a sense of its lack of underlying basis, that when the moment of fear strikes makes the panic all the more real. So timeframes in that environment are very brief. In your original remarks, you were talking about the tortoise and the hare, in effect, that well-decided stocks based on low volatility and sticking with your decision, Buffett-like, Warren Buffett-like, has in the long term the winning hand.
I think that's pretty much true. If you look at what is the major driver of, let's say, the S&P 500, what drives that? It's a really interesting question, because in my opinion, the major driver of the S&P 500 is this learning process. The market's learning about it, what its risk is. The market is truly highly risk averse in terms of the longitudinal behavior of the index. If you look at, it's a simple thing, and we all can do it. You can go back to your offices and do it in a minute. If you plot the percentage changes in the S&P 500 against the percentage changes in the VIX, the R-square, and go back as far back as you want to, the R-square is 50%. that means 50% of the day-to-day movements in the S&P 500 can be attributable to changes in the VIX, which is what the market thinks its risk is. As the market thinks its risk is going up, the value of the S&P comes down because the market is highly risk averse. And when it learns that its risk is higher, however that learning process is, it reacts. If you look at the biggest changes in the VIX over history, and you try to find events, real events, that cause those, they're not there. You can't find anything that causes them. And with respect to the flash crash, everybody wanted to know what caused the flash crash. If you look at the news coming in, there was nothing there. Nothing was coming in to cause the flash crash. And then people say, well, must have been people making mistakes in their trading.